Are you one of those persons who entered the stock market during the pandemic crash or after March 2020? Then this video is a gentle reminder to you guys. Subscribe to the channel if you haven't already because we have got lots of good videos coming up. Now, the purpose of this video is not to discourage you, but rather make you aware of the emotional damage that the market can cause in your life. I'll try to explain this with the help of the dunning-kruger effect or the dunning-kruger curve. This effect is named after researchers David Dunning and Justin Kruger. This was the result of a series of research and social experiments that they have done. We can make use of this curve to learn a great deal of information regarding novice traders. In fact, this weird looking curve can help you understand the life cycle or simply the journey of a trader who entered the stock market during a bull rally. Now, the x-axis of this curve is knowledge, which is rated from high to low, and the y-axis is confidence ranging from 0 to 100%. The market can make a trader or an investor extremely overconfident when it's in a bull run. The market will make you increase your money investments at higher levels. Now, those traders who have been in the game for a while and those who have seen previous market cycles and know how to play it will make a lot of money in a bull market. But for those with a limited knowledge and experience, market success in the first few months or years in their entrance can do more harm than good. Now let's take an example to understand this. Ravi, an IT professional, enters the stock market in May 2020. Now the market has just crashed and the top companies are trading at a discount. That is 40 to 50% lower than the prices just 2 or 3 months ago in February 2020. Ravi has lost his job due to COVID lockdown across the country and he has a family to look after. So he decides to try his luck in the stock market. He hopes to make investing or trading his full-time profession through which he can earn more money and enjoy his work from home. This wish to be a full-time trader has two possible outcomes. If this plan works out, he would never have to worry about taking up a job ever again. But if the plan fails, he will lose a lot of money on top of being unemployed. But as they say, timing is an important factor. And there is no better time to enter the market than when there is a crash. Now, entering the stock market is easy. The initial investment required is almost close to zero. All one needs is a smartphone and the amount required to open a demat account, which is usually less than Rs 500 in case of a discount broker. There is hardly any investment, but there is a great chance to earn a lot of money. This is all what a beginner thinks about when entering to the stock market. Now, Ravi bought some shares of a few top companies that he knows, like HDFC Bank, TCS, etc. in May 2020. Immediately after the purchase, the stock price begins to rise. After all, a new bull market seems to have begun and he is liking it. Now he starts to read some forums, Twitter, Telegram, watches a few videos on YouTube and follows some of the successful YouTube traders. These people would recommend smaller and lesser known companies which are moving 5 to 10% almost every day. A dream come true, right? Now he begins to watch financial news channels and more company names are being recommended with big targets on CNBC or TV18. The analysts on these business channels are sounding super bullish. For Ravi, making money is now as easy as that. For a moment, he begins to think, why buy stocks like HDFC Bank or TCS which are costly and on top of it, they are moving up by just 1 to 2%? Why not invest in a stock that's being recommended on the YouTube channel or these business channels which has just broken out of the charts? Now he starts to buy a few low quality companies just to check them out. And to his surprise, these stocks begin to give 30 to 40% returns in a short period of time. Now Ravi begins to get more confident. Making money in the market isn't difficult anymore. His stocks continue to move up. Now Ravi makes another move. He breaks his fixed deposits and other savings to buy more shares that are being recommended. Come on, let's face it. His stocks continues to boom. Ravi is now earning 7 to 10% in a week, the kind of returns that a fixed deposit would give in 1 to 2 years. Now the bull market is roaring. Ravi's stocks are touching new highs. The FD amount that he invested is also giving tremendous returns. His confidence is hitting new highs too. Now he thinks of selling his land or taking a loan to invest in the stock market. Interest on personal loan is 10 to 12% per year on an average. And in the market, he's able to earn that much returns in just a month. So taking a loan won't matter much. And as his greed for quick money increases, he brings more money into the market. He buys more small companies in news and telegram channels that would skyrocket within weeks. As Ravi ventures deeper into the market, he also learns about the derivative segments like futures and options. It's possible to make money even faster there, and the brokers will also provide additional margin. This is looking like a jackpot for Ravi. Now, the bull market is speaking. Ravi's confidence and portfolio are both touching the sky. His portfolio is now full of companies which most people haven't even heard of. This is what the first phase of dunning-kruger's chart represents. A trader who has very little knowledge but is very much confident. His knowledge level is in that low region, while his confidence level is near that 100% region. Now guess what happens next? The markets won't go up indefinitely. It might stop at some point of time to take some rest to cool things off. And the next thing you see is the fall. And the fall is inevitable. Anyone with the knowledge about the market structure and the market cycles know this. Ravi did not exit his winning positions in the anticipation that the market will continue to rally. Sadly for him, some of his stocks crashed beyond repair. His futures and options positions are also deeply in red. Now he is in a bad position and in an even worse state of mind. Unfortunately, this is the story of most individual investors in the stock market. Either they enter the market when the market has already run up a lot, or they go on to buy mediocre and small companies and eventually end up losing all their money when the market crashes. At this point, most people say goodbye to the market when they see their first bear market, because the losses can be truly unbearable, especially if borrowed money has been invested in the market. This has happened in 2008, in 2011, and after the mid-small cap rally in 2017. And guess what? It will happen again. Just that no one knows when. Now this is the second phase as represented by the curve. The confidence of a trader gets shattered. The confidence level is near zero. The bull market ego and arrogance would severely be punctured too. Now the overconfidence that making money in the market is easy will also vanish. Only a few survive to graduate this course. In fact, a very few get past this stage. But for those who survive, they will begin to learn that making money in stock market is not easy. They will accept the fact that to make a living out of the market, it requires knowledge, it requires experience, and most importantly, it requires a lot of patience. The market will eventually end up teaching its new participants some lessons which they will never forget. They will begin to realize that the only way to succeed in the stock market is to survive and to be a lifelong learner. This is the journey towards a successful trader or an investor as portrayed by the final phase in the curve, the phase of being humble, the phase of acceptance, and the phase of accumulating knowledge. I hope the video was useful to you. If it did, please do like the video and share it with your friends. I will see you guys in the next video. Till then, see you.